Let everybody in. And we are good to begin.
All right, thank you. Good morning, everybody, and welcome to this morning's meeting. Erin, would you please take attendance? Oh, sorry, the meeting has now started. It is 9:02 a.m.
Certainly. Adrienne Cochran? We know she's present, but she did say she may step away for a moment, so I'll come back to her. Ellen McKittrick?
Present.
Mike Soltis?
Present.
Holly Williams?
Present.
Okay. We do have a quorum.
Okay, thank you. And I would like to thank any members of the public who are joining us this morning. We're going to move on to our first agenda item, which is review and approval of the April 25th meeting minutes. I would like to ask the committee for a review of those minutes and a call to approve.
Motion to approve those minutes.
Thank you.
Second.
And thank you. All in favor?
Aye.
Aye.
Aye. Any opposed? Any abstentions? I will be abstaining because I was not present. Any other abstentions? All right, then the motion carries. We are now going to have our spring group that is going to present our actuarial quarterly update.
And Harindra and Viva, I wasn't sure who wanted to share, so you both have the capacity to share your screen.
Thank you. Good morning. Yeah, I will share my screen now. Can you just confirm that you can see my screen?
We can see your screen.
Great, thank you. Okay, so the purpose of my part of the presentation today is to go through the results for Q3 of the fiscal year. So the time period July 2024 through March 2025. I'll run through the key results, talk a little bit about some of the detail there, and then also discuss the updates to the projection for fiscal year 2025. So this page provides a summary of the key results. Overall, the net activity for this 9-month period was 19.9 million. That compares to the prior projection, which we presented in March of 13.4 million. So net activity was better than forecasted. A few different items related to that. One, contributions were higher at 359.9 million compared to the projection of 357.8 million. Investment income was also a little bit higher, about $1 million higher at 21.1 million. And incurred claims were lower. So incurred claims were just slightly lower at 333.9 million. I will point out that the prior projection as well was updated back in December with an updated claims review, and then revisited again at the end of Q2. Okay. Other expenses were more or less similar to what we had projected last time. So, but overall, with higher contributions, higher investment income, and lower claims experience, that all contributed to better net activity for the period, which in turn results in a higher ending fund balance. So the ending fund balance is 648.6 million. Okay. Overall, the funding metrics continue to remain, actual funding metrics continue to remain below target. This quarter, we thought it would be helpful to just talk about what the funding metrics are, or just provide a bit of a refresher for the group. So I'm going to just do that right now. We have 3 items here: reserve compared to the net fund balance, contribution levels compared to the net fund balance, and then a metric around adverse losses over 1 year compared to the net fund balance. And you'll see, in particular, the adverse losses over 1 year is now a little bit, we're fairly close to the target. And it would not be unexpected that we may even breach this target in the future. So I just wanted to point that out. So while the funding metrics suggest that the funds remain strong, we are approaching with higher claims. This one funding metric, which is adverse losses over 1 year, being compared to the net fund balance. Okay. Just as at a very high level, if I run through these three, let's go flip to the appendix here. The reserve compared to net fund balance basically represents how much the reserve how big the reserve is compared to the fund balance. And in a perfect world, you don't want that reserve to be too big relative to the fund balance. So that's what we recommend, that the net fund balance should be at least 1/3 of the reserve. So you'll see here, go back, sorry to flip around a bit, the ratio is 3:1. So the net fund balance being 1/3 compared to the fund balance in terms of the target. Now we're well below that in this case, so because the reserve tends to be very small relative to the fund balance. Okay. The second item is around contributions. So in other words, it's a measure of the adequacy of the net fund balance to cover inadequate contributions. So in other words, if contributions fall short, you want to make sure you have enough money in the fund. The target recommends that net fund balance should cover at least 1/3 of next year's contribution. So that's sort of how the target is set up. Adverse losses over 1 year. This is the measure of the adequacy of the fund balance to cover adverse losses, probably one of the primary functions of the fund. The way we look at adverse losses is we look at next year's claims and say, okay, if the claims increase by 50%, do we have enough funds to cover that loss? And in particular, can we do it back to back over 2 years? So that's where we have that 0.5 factor, if you will. In other words, the net activity in the year with adverse losses is less than half of the net fund balance. So if that activity continues for 2 years, then in theory we would use up the fund. Now, again, these scenarios are not common, but these are simplifying metrics to try to get at the fund balance and the adequacy of the fund balance itself, of the fund itself. So, other scenarios that kind of can be similar or can be thought of in a similar fashion are, okay, if you have adverse losses over a multi-year period, then perhaps it's not as high as 50%. So let's say it's 10% higher or 20% higher than expected, over multiple years. That could result in a similar type of basically using up the fund and resulting in the fund balance being too low at the end of the day. So this metric is, again, a simplifying metric to capture that sentiment. But we did want to, thought it would be helpful just to do a refresher of this. We had set this up a few years ago and continue to monitor the metrics again, the actual metrics against the targets. And just because particularly we were coming closer with this last metric, that would be helpful just to refresh the group with that. Let me just go back to this page and just mention one other thing here. So overall, we do still have $648.6 million. So as overall, what that means is that we still have sufficient funds funds available to cover costs in the future. But as we have looked at in the past, when we look at a longer term period, and in particular in the context of increasing claims experience, there is the risk that the fund balance will continue to get depleted, will get depleted in the future. So I just wanted to mention that as well. Okay, so with that, I'll move on to the next couple pages. This next page, similar to what we've shown every quarter, just provides a graphical illustration of the same results. So overall, again, you can see revenue, which we made up of contributions, and investment income is 381 million. So that increases the fund, and your claims and other expenses decreases the fund. In total, that was about 361.1 million. So that's how we ended up at the $648.6 million ending fund balance number. This page just provides the detail. I won't spend too much time on this at this stage, but we'll leave it in the material for your review. And then the last item on our prepared material is to talk about the fiscal year projection for 2025. This quarter, unlike prior quarters, we didn't update the annual figures, so the annual projection based on this most recent quarter's results. It is in part because we saw better than expected result, or slightly better than expected result on a number of fronts in terms of contributions, investment income, and claims. They were all positively impacted the funds, albeit slightly. So we didn't see a reason to update the projection at this stage, particularly because we wanted to maintain some level of more conservatism given those favorable results for the last quarter. Okay, with that, I'll open it up for questions.
I have a question. Oh, Mike, you go ahead.
Sorry. Harindra, thank you for your presentation. So if I heard correctly and understood correctly, one reason that our net activity is better than projected was because we had lower claims expense, lower claims experience. And I'm trying to understand how we have lower claims experience, but then one reason that metric for the adverse losses is narrowing is because of increased claims. And obviously our concern, we talk about this every meeting, is what's the trajectory of the claims? So can you kind of reconcile those two?
Sure.
We have lower claims experience, yet we're having increased claims?
Yes. So I'll point out, I mean, we did have lower claims experience, but it's only a few $1 million difference compared to what we projected in March, or what in the last presentation, last quarter. So it's not materially, like in the biggest scheme of the fund, it's only a few $1 million. So it's not like a large swing, and it is reflective of an updated claims projection where we had prior to that bumped up the claims based on looking at historical data, right? So yes, this one quarter had slightly lower experience, but in the bigger scheme of things, we are seeing still a trajectory of an increase in claims overall, right? Compared to the prior year, if you looked at the trend month over month, we are still seeing an increase in claims. So yes, this is more of a short-term view, an update compared to last quarter. But when you expand the horizon and kind of look at it over a longer term period, there is an increase in claims.
Can I just interject? Because the way I think about it is we have the projections from last summer. And over the course of the summer and the fall, we knew that those projections were low because claim volume was increasing. So in December, Spring reran their projections with updated assumptions. And so because we were just over, like our incurred claims were always over. And we're like, well, what do we think the claims are really going to be? So in December, Spring reran their projections and bumped them up. And then it turned out that in this past quarter, they were slightly lower than those increased projections. Dave, I think you have a chart that we've used internally that kind of compares the projections, which are equivalent to the budget, because when Dave will talk about the budget numbers, we're always saying that the claims are over budget. So I think we could show that maybe. That might be helpful if y'all think that would be good.
I can bring it up.
Okay.
Okay, hold on. Rendra, I'm gonna stop your sharing so I can.
Sure.
Thank you. Okay, so like Erin said, this is what we use internally, and what we have here in this column are the actual claims paid on a monthly basis for the current fiscal year. And the second column shows what we budgeted. And as Erin said, month for month, we've been beating that original budget. But we have revised the projections over time to reflect the reality that we have a higher claims experience. And so based on those claims, you can see that while our actual claims paid is still over the projection, it's not nearly as much as the budget, but we're still over that projection slightly, typically by about 102% in the most recent months on average. So for the most recent projection that Harindra did, which was January through March, the numbers did come in lower. And part of that, I believe, is due to seasonality, especially in January and the early parts of February. There's still a holdover from Christmas. People aren't putting in as many claims as they normally do, but that starts kicking in January and goes into February until you start seeing the normal trends again. So there is some seasonality in there, and it happened. It spilled over a little later than usual from what I saw. Normally it happens like late November and December. This time it spilled over a little bit into January. And so that's why the results are a little lower than what we projected. But I don't think, as Harindra said, that affects the overall trend that on an annual basis or on the whole, we're still seeing this rate of claims being paid that's at the higher level, Mike. And so that's why when you look at the, I'll stop sharing now. That's why when you look at the adverse test, it is getting closer to the metric. I mean, for now, we're still solvent. There's no issues there, but we are closer to that metric number than we have been before. So we just want to bring it to everybody's attention and let everybody know we're aware of it. We're looking at it, and we'll continue to look at long-term trends to see if this is something we need to possibly take action on in the future. Does that help you, Mike?
It's very helpful. I mean,
Okay.
my summary is the big picture is the long-term trajectory continues to rise.
Mhm.
And in the last quarter, we had a minor blip downward.
Right. Right. I mean,
Okay.
the numbers are the numbers. So,
Right.
but we don't want that. But that's the reason why Harindra said the projection is staying the same. We're not
Right.
lowering it because we had one quarter where the numbers they were better, but it wasn't like we had this, huge
Right.
positive variance.
Right.
So we're being cautious and we're being conservative
Well,
as we
that's
always are.
very helpful. Thank you.
Okay, you're welcome, Mike.
Any other questions? Actually, that discussion brought to close my question. Are there any other questions from the group? No? All right. Thank you. I actually had just one administrative question. The sensitivity analysis that we see sometimes that does the under over on the claims projection, we'll see that at the next annual actuarial the next time you guys do like your next annual projections, correct?
Yes.
Does
Yeah.
that make sense? Okay.
Yeah.
All right. Thank you. Okay. So thank you very much, Spring Group, for sharing that with us this morning. And we're going to go over our budget review of spending to date, and Dave is going to share that with us.
Okay, I'll leave my microphone on and I will share again. Okay.
We can see yours. Well, we can see your screen.
Thank you. Yep. No, I did just making
There
sure.
we go. That's what you
Making sure
want
I'm
to
sharing the right thing, Aaron. Okay, here we go. Okay, we are going to talk about the results this morning through the period April 2025. It was a typical month. It was par for the course, quite frankly, in terms of results for the authority. So for operating results, month to date, our net activity was just over $4.0 million, and that was a $358,000 positive variance. We did transfer over $5 million for the administrative fees for the coming quarter. Significant expenses won't surprise everybody when I list them out. Payroll and related expenses were $718,000. Contact center was $132,000. Outreach efforts were almost $95,000. So that makes up the bulk of the just over $1 million of operating expenses we had. That resulted in a positive variance of over $342,000. Year to date, our results are over $4.5 million. That is a negative $788,000 variance. Again, that's because we didn't transfer the $5 million the previous quarter, and so that money is remaining in the contribution fund where you will see the offsetting positive variance there. And just as a reminder, we left the money there because we had enough in operating reserves. So we left the money in the contribution in the STIF account where it earns interest. Year to date, our expense variance is just under $4 million. Most lines have a positive variance. The one significant one that has a negative variance is the fund recovery fee at negative $88,000. But that's because our fund recovery activity also has a positive variance. So the expense to get those fund recovery penalty was higher than usual as well. So that's what I like to call a high quality variance. Moving on to bond activity. Our bond activity for the month was $56,000. Continue work on our fund recovery system. That was a positive variance of almost $44,000. We've spent or used over $875,000 of bond money this fiscal year so far through April, with a $124,000 year-to-date variance. We expect to be at that variance, maybe a little lower by the end of the fiscal year. Just moving this a little bit because my screen is not cooperating this morning. Where that puts our bond fund at the end of April is just over $1.5 million. So we have $1.5 million available for future spending for fund recovery or any other system projects that come along. Moving on to contribution activity for the month of April. April is the month when contributions come in for the quarter. April is the grace period for the prior quarter. So that's why we have a large positive number this month of over $101 million. We do have a negative variance of over $2.8 million compared to budget. Again, that's because of benefits paid. We had over $35.5 million of benefits paid. That is a weekly trend of $8.9 million. That's slightly up from last month, which was an average trend of $8.8 million a week. So to our discussion before, Mike, we're still seeing benefits paid out at the regular rate and going up a little bit. And we have had some record-breaking weeks. We had one record-breaking week in the month of April. So benefits are still being paid at the current rate. Let's talk about the money coming in for a second. Contributions were almost $141.5 million. That is a positive variance of $2.8 million for the month. Fund recoveries were still strong at $70.3 million. Investment income was almost $2 million. That is lower than what we budgeted. That's not typical. The reason for that is because since benefits are coming in at a higher budgeted rate, we expect the fund balance to be higher. And since the fund balance was higher, there was more of a principal to earn interest. But since we have less earning interest, the interest amount is less than what we budgeted. We still are earning 4.4% in the STIF account, but that's why there's a negative variance for the month of April. Having said that, looking at our year-to-date numbers, we're still almost $3.7 million ahead of budget for investment income, and we do expect to have a positive variance for that by the end of the year. Year-to-date activity in total for the contribution fund is over $100.3 million. That does have a negative variance of over $31.3 million compared to the budget. Again, the biggest driver of that is benefit payments being higher than what was budgeted over a year ago. But every other line does have a positive variance, and that is the offset. Wanted to just take a minute and talk about contributions by quarter. So if you look at this chart, the green column are the contributions for the most recent quarter for 2025. This first section is the first quarter, the second is the second quarter, third quarter, and so on. So the contributions for the most recent quarter were $143.5 million. Comparing that to the same quarter last year, which is the yellow column to the left of it, of $138.3 million, that is a $5.2 million increase over the same period last year, or 3.8%. So that tends to be the typical trend that we're seeing for contributions being higher than the prior quarter, somewhere usually around the neighborhood of around 4 to 5%. So we are still seeing that trend. The first quarter of the year, as you can see, is always the highest for contributions. That is because bonuses are paid for the prior year, typically in the first quarter of the year. Pay increases for many companies also go into effect the first calendar quarter of the year. And what happens is, as time goes on for the rest of the year, more people hit the FICA cap, which is also the cap for paid leave contributions. So there's less contributions coming in because more people hit the cap, and there's less coming to the authority. So that's how that trend works, and it's been working that way, as you can see, for the past 4 years, and we don't expect that to change. As I like to say, what does that all mean for the contribution fund? It means the following. The fund is in at lucky number 6, over $666 million in the fund right now. As Harindra mentioned before, we are solvent, and we do have money to pay benefit expenses, as well as administrative fees. Taking a quick look at the assets of the authority, we have over $688 million of assets. The biggest part of that is the trust fund and the money invested in the short-term investment fund. We have over $640 million in there now. Again, it is earning 4.4%. And the other assets include leftover bond funds of $1.5 million and the operating reserves at almost $17.7 billion. We still have an impressed account at Aflac of $17 million to pay benefits, and net fixed assets of $2.4 million. On the liability side, it's still the same. Bond funds payable of $12.8 million. We will be making our next bond payment next month in June, and that'll be about $2 million. So you'll see that in a few months. Talking about where we think we're going to be for year-end projections, our net activity is expected to be over $1.6 million. That's a $253,000 negative variance. Again, that's because we didn't transfer the $5 million. So that means we have a positive expense variance of over $4.4 million. The reasons for that continue to be the same. The pension rate for payroll was better than we expected for budget, so that gave us a positive variance. Positions were filled later than expected, and there's one or two of them that are still open. So that creates a positive variance for payroll as well. And the other significant factor is that IT consultant services, we used bond funds to pay for that instead of the operating funds because they were applicable for bond funds. So we used them. And those were the two motivating factors. Other factors include we didn't use the contingency. Outreach expense was lower than expected because the CECI initiative had less vendors than we expected. So that contributed to the positive variance as well. And finally, the contribution projection is the same as last time. As Harindra said, his projection over at Spring didn't change, so ours didn't change either. We're still expecting over a $14.5 million net positive activity for the year. That's obviously less than budget because of the increased benefits paid that we've seen over the past few months. But we still expect to be ahead of the game by June 30th of this year. So that's where we are through the month of April and where we expect to be at the end of the fiscal year. I'm happy to take any questions at this time.
Any questions?
May I ask a question here?
Yeah, of course
Of
you
course.
can, Mike.
Dave, so that chart with the quarterly contributions, I think is very helpful. And I'm just curious, you said we're in this 3.8% increase contribution kind of trend. And I'm just wondering what contributes to that. And two things come to my mind that I'm wondering if I'm missing anything. Number one, the increase in the minimum wage, right, which increases the formula for the payouts.
Yes.
And the other one, increased economic activity in the state. Is that a fair barometer?
It's a fair barometer. I think that's less of an impact on the state. The employment numbers have been pretty solid over the past few months. So they certainly haven't gone down. So there certainly are, the unemployment level is relatively low. So there's certainly as many people, almost as many people working in the state as they could be. Wages typically go up every year beyond the minimum wage increase, beyond the bonuses for the prior year that I mentioned before that contribute to the increase. There's also increases that companies have that they give their employees. And so those are, those can be typically anywhere between 1 to 3%.
Mhm.
In prior years, we did see there was a lot of wage pressure where wages were going up significantly, theoretically to catch up with inflation. That was number one. Number two, companies were having trouble hiring people, if you remember those days. So they actually had to increase their wages in order to get people to come into the door. There's still some of that. That's not nearly as much of an issue as it used to be, but anecdotally, I still see like help wanted signs on various businesses. So they're still looking for people to come in. So they still have to offer competitive wages for those people. So that is also contributing to it.
Right. But I'm just wondering, are you seeing any significant increase in the level of employment in the state?
I'm not seeing a significant level of employment. Like I said, it's been pretty steady lately. So last we looked at it, actually, so in terms of like raw numbers of people that are employed by the state, it's still not at pre-COVID levels. So like 2019, early 2020, the number of people employed in the state is the raw number is still not at that level yet. Interestingly. So, but if you look at the unemployment numbers, they're still relatively low because some people are just they're not looking. So that's still a thing, as my kids like to say.
All right. No, thank you.
It
You're
is,
welcome.
we do work closely with DOL and the data folks over at DOL. It's a little tricky because their data is a couple quarters back and then it gets adjusted. So we are very cautious about jumping to conclusions because there's always an adjustment the following quarter. So we've learned to just be like, okay, well, we're going to watch trends. I think the good news for Connecticut, even though we're not fully back to where we were pre-pandemic, employment levels are strong. And as Dave points out, the wage levels are at a good place as well. So people are sometimes you can see people being underemployed, and so the unemployment number is not the full story because there's underemployment. But we're seeing that Connecticut's economy is strong.
All right. That's good to hear. Thanks.
Any other questions or concerns? All right, I don't see any. Thank you, Dave. And so this morning we are going to move on to any old business anybody would like to discuss. New business. All right, may I have a motion to adjourn?
Move to adjourn.
Thank you. And a second?
Second.
Thank you. All in favor?
Aye.
Aye.
Aye. Any opposed? Any abstentions? All right, the motion carries and the meeting is adjourned at 9:40 a.m. I hope everybody has a wonderful long weekend.
Thank you. You
Thank
as well.
you. You as well.
Thank you.
Thank you,
Bye.
everyone.
Thanks, everybody.
Everybody.
Bye-bye.